We get this question, should I sell before I buy in San Antonio? Here are 7 things to understand before considering a bridge loan at the luxury level. If you own a home in the Tri-Cities or anywhere across San Antonio, and you're starting to think about your next move, you've probably run into the same uncomfortable timing question that almost every move up or move laterally seller hits at some point. Do we sell our current home first and then go shopping? Or do we buy the next home first and figure out the sale along the way? And somewhere in that conversation, usually from a lender or a friend or a late night search, the words bridge loan come up. And this is exactly what we want to walk you through today. Because at Park Properties Group at the Phyllis Browning Company, we spend a lot of time helping homeowners in these areas think through the financial choreography of moving from one home to the next. And those bridge loans are one of the tools that sounds simple in concept, but has a real nuance once you actually use one. So this video is for the homeowner who's weighing their timing, exploring options, or just trying to understand what is actually possible. And nothing here is legal, tax, or financial advice. Not at all. Since we're not lenders, attorneys, or financial advisors. But any specific decisions that you make, you should talk to your loan officer, CPA, and where appropriate, a Texas real estate attorney. So now let's get into it. Starting with number 1, understanding the core dilemma to a bridge loan is trying to solve. Because before we talk about the loan itself, we have to talk about the situation that creates the need for one. And usually that looks like this. You own a home, you have substantial equity, and you're ready to move into a different home. The home you want to buy is available now, but you cannot easily access the equity in your current home without selling it. And you really don't want to lose the next home while you wait for the current one to close. And that is the squeeze. And the equity is real, but it's locked inside the existing home. And the next home is real, but it has its own timeline. So the question becomes, how do we unlock enough of the current equity to make the next purchase happen without forcing a fire sale on the home we already own? And that is the exact problem a bridge loan is designed to solve. It temporarily lends against the equity in the current home so that the next move can close on its own timeline. And the bridge loan is then paid off when the current home eventually sells. And at the luxury level, the dollars involved make this conversation more serious than it would be on a typical starter home, because the stakes on both sides of the transaction are larger, which leads us to number 2, to understand in general terms what a bridge loan actually is, because there's no single standard product and different lenders structure these differently. But the general idea is it's a short-term loan, often 6 to 12 months in duration, that is secured by your current home and sometimes by both homes. And the proceeds are used either as the down payment on the new home or to cover the closing cost on the new home before the old home sells. And the loan typically carries a higher interest rate than a traditional mortgage. You need to remember that, since it's a short term and the lender is taking on a transition risk. It usually has fees that are higher per dollar than the standard refinance, and since the lender is structuring something custom around your specific timeline. So when you hear bridge loan, the picture to hold in your head is not a 30-year mortgage. It is a short, more expensive, more flexible piece of financing that exists to buy you time. And time in real estate often has real value, which brings us to number 3. Understand when a bridge loan can actually make sense. Because while bridge loans are not for everyone, there are a handful of situations in our luxury market where they can be the right tool. First is when the home you want to buy is generally rare, meaning it does not come up often. The inventory is thin, and waiting on the sale of your current home would almost certainly mean losing it. And at the upper price ranges in those areas, this is not hypothetical. This is a regular reality we see all the time. The second is the timing of your current home sale is unpredictable. Perhaps it's a unique luxury property that may take longer to find the right buyer, and you don't want to be forced into a price decision under time pressure. The third is when you have substantial equity and strong income, so the carrying cost of the two homes briefly are tolerable for the runway the bridge loan provides. And the fourth is when the traditional contingent offers are unlikely to compete in your target neighborhood. Since many luxury submarkets, a non-contingent offer is dramatically stronger than a contingent one. And a bridge loan can be what makes a non-contingent offer possible. So when any of these factors line up, the bridge loan stops being a panic option and starts being a strategic option, which leads us to number 4. Understand when a bridge loan usually does not make sense, because this is just as important as knowing when to use a bridge loan. The first situation is when the math is tight, meaning your equity, income, and reserves do not comfortably absorb the carrying cost of 2 homes, plus the bridge loan itself, because the moment something slips into the timeline, a tight situation becomes a stressful one. And second is when your current home would likely sell quickly with normal marketing, because if you have the patience to list first and accept reasonable timing, you may avoid the cost and complexity of a bridge loan entirely. And third is when your next home you're buying is not actually irreplaceable, meaning there will likely be a similar home available maybe 3 to 6 months, in which case the urgency justifying the bridge loan may not really be there. And fourth is when you have other liquidity options like investment accounts, a HELOC open in advance, or family resources. And that could fill the same gap without having the same cost profile. So the honest answer for many sellers is that a bridge loan is one option among several, and the right one depends on the specifics of your situation. Which brings us to number 5, understanding the costs and risks before you sign anything. Because at the luxury level, these are real numbers and they should be examined carefully. The first cost is interest, which on a short-term bridge is typically higher than on a standard mortgage. And over 6 to 12 months, a substantial principal balance that really adds up with that interest. The second is the origination and closing fees on the bridge itself, which are usually higher per dollar than the refinancing because the lender is structuring something short-term and custom. And the third is the carrying cost of the current home while the bridge is in place, including the existing mortgage, taxes, insurance, utilities, maintenance, and our luxury price points. Those carrying costs are not small. The fourth is the risk that the sale of the current home takes longer than expected, which can either mean extending the bridge loan at additional cost or accepting a lower sales price to close faster. And the fifth, which is harder to quantify but very real, is the stress of operating 2 homes financially for any stretch of time. And for some homeowners, that stress is worth it because the alternative is losing the next home. And for others, it's absolutely not. So the only way to evaluate this honestly is to put real numbers on paper with your lender and CPA before you commit, which leads us to number 6, understanding the alternatives. Because a bridge loan is not the only way to solve a sell before you buy timing problem. And a thoughtful conversation should always include other options. An alternative is a contingent offer. So what that means is your offer on the new home is contingent on the sale of your current home. And while contingent offers are less competitive in many luxury markets, sometimes they still work in the right situation with the right home. The second is a HELOC, or home equity line of credit, opened on the current home well before you start in advance house hunting, which can sometimes provide enough liquidity for the down payment on the next home without the cost profile of a full bridge loan. And although HELOC availability at the luxury level depends on the lender and the specifics of the property, you have to check into that. The third is a leaseback after closing, where you sell your current home first and negotiate the right to stay in it for a defined period of time while you finish buying the next one, which can be a clean way to convert equity to cash without bridge financing. The fourth is using investment assets temporarily, although the tax and timing implications of liquidating brokerage assets should always be reviewed with your CPA first. And the fifth, for some homeowners, is simply renting between homes, which is unromantic, but can be cheaper and less stressful than a bridge loan in the right situation. So the bridge loan should always be evaluated against these alternatives, not in isolation. Which brings us to number 7, understand how to actually walk through this decision. Because at the end of the day, this is not a math problem with one right answer. It's a strategic decision with multiple variables. And the most productive way to work through this is to get it clear on 3 things in order. The first is the timeline on the home you want to buy, meaning how flexible is the seller on that home? Can they wait? Is the home truly irreplaceable? How competitive is the offer environment? The second is the realistic timeline on the sale of your current home, meaning what does pricing, condition, and marketing actually suggest about how long this will take? And what is the range of your outcomes. The third is your real financial picture, meaning what is the carrying capacity for two homes briefly? And what are the actual bridge loan terms you would qualify for? And what are the costs and risks compared to alternatives? And once those three pictures are clear, the right answer is usually obvious. Sometimes the answer is a bridge loan. Sometimes the answer is a contingent offer. And sometimes the answer is a leaseback. Sometimes the answer is sell first, rent briefly, and sometimes the answer is wait. And all of those are legitimate. Now let's hit a few quick questions we hear from luxury sellers about this kind of timing. The first one is, how early should we start having this conversation? Great question. The answer is much earlier than most people expect. Ideally, as soon as you start thinking seriously about a move, do it. Start engage with us, because the financing options that take a few weeks to set up in advance are much more powerful than the ones you have to scramble for in the middle of a deal. The second is, do we have to use the same lender we've always used? And the answer is no. Since bridge financing is a specialty product and not every lender does it well, it's worth looking around to see who specializes in this type of structure. And the third is, what happens if our current home does not sell within the bridge loan term? And the answer is that you typically either pay an extension fee, you refinance into a different product, or accept a price reduction on the current home to close faster. And each of those has its own cost, which is why pricing the current home realistically is part of any responsible bridge loan plan. The fourth is, can we use equity from the new home instead? And the answer is, that depends entirely on the structure. But most bridge loans at the luxury level are anchored to the equity in the home you are selling, since that is where the predictable equity actually lives. The fifth is that the single biggest mistake homeowners make when considering a bridge loan, and if we had to pick one, it would be assuming the current home will sell quickly without examining what actually drives that, since the entire bridge loan plan rests on a realistic sale timeline for the current home. And a sale timeline built on optimism rather than data is where these strategies get into trouble. And the sixth is, who should be at the table for this decision? And the answer is, at a minimum, your realtor, your lender, your CPA, and depending on the situation, financial advisor and a Texas real estate attorney as well. Because the financial, tax, and contract implications all interact and they are best examined together. So to recap, number one, understand the core dilemma a bridge loan is solving, which is the timing gap between buying the next home and selling the current one. Number two, understand the general terms of what a bridge loan is: a short-term, higher-cost piece of financing secured by your current home. Number three, understand when a bridge loan can make sense. Generally, when the next home is generally rare, the current sale is unpredictable, and your finances are strong. A non-contingent offer matters in that situation. Number four, understand when it does not. Generally, a bridge loan is not good when the math is tight. Your current home would sell quickly anyway, or the next home is replaceable. Number five, understand the real costs and risks, including interest, fees, carrying costs of two homes, timeline risk, stress. Number six, understand the alternatives, including contingent contracts, HELOC, leasebacks, brokerage liquidity, and renting between homes. And number seven, understanding how to actually walk through the decision by getting a clear on the next home timeline, the current home timeline, and your real financial picture. And the takeaway is simple. A bridge loan is a tool. It's not a strategy. And like any tool, it works beautifully in the right situation and creates problems in the wrong one. So homeowners who use it well are the ones who started the conversation early, examined the alternatives honestly, and built a plan around realistic numbers rather than optimistic ones. And if any of this resonated with you and you would like to think through your own timing, your own equity picture, your own next move, we would love to hear from you. And as a reminder, nothing in this video is legal, tax, or financial advice. Remember, guidance should come from your realtor, your lender, your CPA, financial advisor, and where appropriate, a Texas real estate attorney. Thanks for spending part of your day with me. I would love to see you. I'm Caroline Decherd with the Park Properties Group at the Phyllis Browning Company. If you're thinking about buying, selling, relocating, investing in Alamo Heights, Terrell Hills, Olmos Park, Monte Vista, or anywhere in San Antonio, we'd love the opportunity to help. Reach out anytime. Have a good day.